following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Traders Workshop. I'll be your host, Tom Schneider, CMT with NinjaTrader, and it's always my pleasure to welcome back the founder of Traddictiv, Jose Blasco. How you doing, Jose?
Hey, Tom. Hey, everybody. Pleasure to be here. I'm doing very well. How is everyone?
Excellent. Yeah, I think, well, I can only speak for myself and my colleagues here in the States, and we're heading into a day off tomorrow. So I think, we're feeling pretty fine here.
Very nice. It's always weird, isn't it? As passionate traders as we are, you have a market holiday, and in one hand, it's like, okay, yes, I have a day off. In the other hand, then you miss it. So
that's exactly it. It kind of disrupts the rhythm of the week, right? Because as traders, we get into a rhythm. Monday is different than Wednesday. That's different than Friday, right? So any disruption to me is not really welcome. But when you have a day off, you welcome those. You take them when you can.
Of course. Yes.
So how are you doing, Jose?
All very good. All very good. Same thing as you say, you just mentioned, market routine. So, we're in the middle of the week. All very good. Just one of those normal weeks, apart from the fact that tomorrow is a market holiday.
Right. And you focus on the U.S. markets. I have insight into your screen right now. Know that you look at the European markets or the U.S. markets, but you're not in the U.S. You're over outside of Singapore.
Yeah, I'm 12 hours away from the U.S. time zone, the New York time zone to be specific. So, when it's, 9:30 a.m. and the market's open over there, for me, it's 9:30 p.m. And
right.
It's end of the day for me, yes. So, yeah, which is convenient, to be honest.
Yeah, especially when you have a young family like yourself.
Yes, indeed.
Excellent. Well, we've been very lucky to have you on the show for the last few weeks, and I really enjoy what you're doing and learning about what you're doing. So maybe we can walk through what we've run over just real quick, kind of that process that leads up into today's topic.
Yes, definitely. Yeah, I mean, in the end, trading, there are many ways, of course, on how to trade, many techniques, many approaches, many philosophies. Mine is to be systematic, to be mechanical, to be rule-based. So you can have a set of actions which are consistent. And if that trading plan comes with an edge, so then that consistency of action should translate when it comes to consistency of results. Being, a trader who takes trades based on all sort of decisions which are not following a rule set may put you in a situation where your action is random and therefore your results may be random. So that's my mindset, that's my philosophy. And in this sense, it's been a pleasure to have the prior conversations to today where we talked about this step 1, step 2 type of thing, and where step 1, I will be zooming on my screen now just to be a bit more visual. So on step 1, what we discussed was to look at some time frame. In this case, we're looking at Nasdaq futures on a 15-minute time frame. So what I am reminding everyone here is kind of like intraday trading, even though the same philosophy could be applied with a different set of time frames and make the methodology either faster or slower. But basically, step 1 is to look at this, slightly higher time frame intraday in this case, and look at what we call the climate, which is kind of like a permission tool. It either gives you permission to go long or to go short or no time to trade, which in this case, this is when we got those thin dots. That means no time to trade. When the dots are thick, time to trade. If it's red, to the short side. If it's blue, to the long side. And by having that step 1 clear, which could be done in many ways, could be trend trading, trend lines, could be moving averages, you name it. In our case, of course, we develop technology for NinjaTrader. So we have built auto climate, which makes it very easy. And the goal of that step one is to not to be caught on the wrong side of the market, to be long when it's time to be long, to be short when it's time to be short. Statistically speaking, of course, we will not be right all the time. So then we'll talk about risk, which risk management and so on, which by the way is the key topic for today. So step one in this summary, we look at the market direction, we call it the climate. Once we understand which is the direction in which we have a statistical advantage, then step two, we look for entries, and then step three for exits. So entries and targets. Exits also imply stops, because you can be exiting a trade as you are right, you can be exiting a trade as you are wrong.
Right.
How do we look at those entries and exits? Well, we look at those UFOs, which in this case, I am actually looking at 3 timeframes on the top of my chart, which is number one, the 2-minute time frame right here. Number two, on the right side of the chart, I have volume charts as well as tick charts. So I'm looking at time frames that are depending on time and time frames that are depending on things other than time. In this case, trading activity, either in the form of number of trades or number of contracts. And basically, we're looking for those UFOs, which stands for on-field orders. And of course, they also look like UFOs. Flying saucers. And those are going to be setting our entries, right? And so, for example, if I was to use this one on the right to set an entry, so the top of the UFO will be my entry, the bottom will be my stop. And when it comes to the targets, then I would be looking at the red UFOs. So, you know, again, if the climate is blue, you want to be a buyer, buy in the green, sell in the red. If the climate is red, you want to be a seller, sell in the red, take profits on the green.
So Jose, just real quick, when we go from climate to UFOs, generally right now, you know, you pointed out we have those in the climate, we have those blue dots, which are long kind of indications, the long bias, if you will. When we see a red bias, we might see something where the UFOs are different, right? So
yes,
right now you see these UFOs kind of green and towards the lower to halfway up through the chart, but if we see a red bias, we might see more unfilled orders on the top. Is that correct?
Correct. I'm just changing to a different market, in this case, crude oil futures, just because, you know, there was a pretty sharp move to the downside a little earlier. So we can see here how, in the case of crude oil, the climate is red instead of blue. And these also translate, I need to get the right tab though, in one moment, right here. Here we go. These also translate on, you know, being able to see red UFOs on the chart instead of green UFOs. So again, it's basically, if it's time to be a seller, your entries are the red UFOs. If it's time to be a buyer, your entries will be the green UFOs. And of course, the target will be the opposite. If you enter in the green, you exit in the red. If you enter in the red, you exit on the green. That kind of approach. And again, this is a very simple process that makes you systematic and mechanical, and there is no human decision within the process, which is a good thing in the sense that, you know, humans, of course, we are emotional beings, we get biased. If you just come from 5 losses in a row, the way you analyze the market is probably different than if you are coming from 3 winners in a row. So the idea here is not to be the decision maker, just to be the rule follower,
Yes.
where basically the opportunities are presented to you and you just follow your rules instead of deciding if you accept or reject, you know, whatever you see in the market, because then there is a subjective component there. Of course, very experienced traders, you know, could certainly manage those emotions and, you know, have a, you know, very a less mechanical, if you wish, way on how to approach your analysis and still be totally okay. But that, of course, also requires a lot of experience and managing all the emotions.
So I like that approach, you know, following rules and, you know, still want to have a little bit of ability to be a little discretionary, but this gives you, you know, bias, this gives you targets. And then, you know, I think the next step we would talk about is kind of managing our trade size as another way to manage risk, right?
Correct. Because again, here's the thing. So let's say there are two traders executing trades in the markets, and let's say they have the very same exact methodology, and all their entries and exits are exactly the same.
Yep.
But trader A is a trader who is very emotional, and depending on how he feels or how she feels, and depending on prior trades, maybe that trader may end up executing with different risk appetite each trade. There are trades that he or she may be risking $100 per trade, other trades may be risking $1,000, other trades $750, other trades $200, and every time is a different amount of risk. Versus trader B, who let's say is a trader who decided, okay, how much is the amount of money I want to pay to see what happens next? Right? So that would be the philosophy. Okay. Instead of how do I feel about this? No need to feel. It's more about there is no certainty. We have odds in our favor when we trade, as long as we have a proper methodology and tools, but there is no certainty. Anything could happen anytime. So how much do I want to pay to see what happens next? That's the question. And let's say the trader concludes that given my account size, given how conservative or aggressive I am, let's say the trader decides, I want to risk $300 per trade. That's my sweet spot, and that's what I want to do every trade. Every trade, I'm happy to risk up to 300, never more, never less. So those two traders are trading the exact same markets, same trades, same entries and same exits, as we said. But one goes with a position size, which imply a constant risk every time, $300 in this example, where the other trader is all over the place, sometimes risking 1,000, sometimes risking 100, right? And so then, so what's right and wrong in which trader should you be, A or B, right? That's the question. So, well, the answer, if we're shooting for consistency, obviously it's you want to be trader B.
Right.
You want to keep your risk constant. Because let's say you have a methodology that, let's say you took 4 trades. And in those 4 trades, I'm just going to try to do some writing on the screen just to be a bit more visual, even though I got all the charts here. So let's say you took 4 trades, in one you lost, and I'm going to call it -1, 1R. So whatever risk, those $300 that trader B is risking. So that trader risk $300 and then lost again one time $300 and then lost one time $300. Let's say this trader got 3 losses in a row. And suddenly this trader now has a profit, and the profit is a 3R trade. He was shooting for a 3-to-1, got the profit this time. It was only 25% of the times. Most of the trades were losing. But as we do the math, obviously this trader broke even.
Sure. So
that's the beauty of, managing a healthy relationship between risk and reward. And since R in this case was always the same amount, $300 in our example, so the trader ended up breaking even. Whereas if the other trader was risking, let's say on the first trade he lost, $1,000, and the next trade is like, okay, you know what? I want to risk less now because I lost too much. I want to risk 200 only. So now he only lost 200. That could be seen as good. But now next thing you know, with the same philosophy, now he's like, okay, I'm losing less now. So 2 losses in a row. Next one for sure is going to be a profit. This kind of bias mindset. So maybe the trader wants to risk more again and now wants to make the money back, maybe risking 1,500. And now, after 3 losses in a row, the trader is like, okay, you know what? I'm going to take it easy. I'm just going to risk 100 now. And now the trader is right. So he actually makes 300 by risking 100. So the two traders took exactly the same trades, same entries and same exits, but their position size was different. The guy on the left made sure that the position size implied a fixed dollar risk amount, where the trader on the right, was, deciding on the fly how much to risk per trade, and that's the outcome. That, I mean, could you be lucky and the losing trades were small amounts and the winning trade was a humongous amount? Of course, you could be lucky, but obviously, that's not a good recipe when looking for consistency, because luck will happen when it happens, but not all the time. So the idea here is to fight the lack of certainty when it comes to what the market is going to do in the future by managing the risk, and this is done powerfully if we keep the dollar risk constant. So if this concept is well understood, so let's take a look at a few UFOs on the screen, since we're talking about UFOs here. And my point here now, as a continuation of what we're talking here, maybe I need to move the chart a little bit to the left. Here we go. That's better. So my point here is that, every trading opportunity is different. Every market is different. Every trading opportunity is different. But we want to keep the risk constant, dollar-wise. So if you trade NASDAQ, which is what I have on the screen, every point is $20. Sure. If we trade S&P, every point is $50. If we trade, pick a market, every point will be a different value. But not only that, depending on market volatility conditions, in my case, I use UFO. So the top of the UFO is the entry and the bottom is the stop. But let's say you don't use UFOs. Let's say you do breakout and your stop is 1 ATR away, for example. So, your stop, you will have situations where the entry and the stop are 3 points away. They have situations where the entry and the stop is 7 points away. Depending on market volatility, you may have different situations for the location of your stops. So how do you adjust your risk so it is always a constant dollar value? Well, we do that with the size. Size changes risk. Mm-hmm. So in this case, if your entry is 36 and your stop is 22, I'm going to go for 22.0 just for easy math. Okay. So we are talking about 14 points of risk, where each point is $20. In the bottom case, if you took the trade below, which is a different market opportunity where you could buy at 85 with a stop at 73, so the distance between 85 and 73 is 12 points. It's not 14, it's 12. Of course, it's the same time frame and it's a trade in the same day, so you have more or less the same level of volatility. So 12 and 40 points is kind of like the same, very similar. But every day will be different and every market will be different. Sometimes you may have 20 points risk, sometimes 50 points of risk, sometimes 8 points of risk. So again, how do you adjust, your risk exposure so you always have this constant dollar risk? Well, that's with the size. So again, let's say the trader, I'm just going to bring a calculator to the screen. So let's say the trader knows that we are trading NASDAQ. The first UFO had 14 points of risk where each point is $20. So you have a maximum, you have a level of pain of $280 if you get stopped out.
That's per contract, by the way, Jose, right?
Exactly. Yep. Very well said, per contract.
Yep.
By the way, if you were to use the micro E-mini NASDAQ contracts, it would be 10 times less, right?
Correct.
Which is, it's very cool because it makes it extremely adaptable, which is the point that I'm making today of changing the size to adjust your risk exposure. So let's say the trader said, look, my sweet spot is to risk $150 per trade. Well, if what the trader wants to do is to risk $150 per trade every time, but this trade using one contract, as you said, Tom, is risking you 14 times 20, which is 214 times 20, which is $280, then you cannot do this trade. You will need to pass. Or you will need to go and work with micro E-minis, yes, which instead of $20 per point, it's 10 times less, which is $2 per point. So now, if you have a risk of 14 points, where each point is $2 per micro E-mini contract, you are now risking $28 per micro. Whereas if the trader said, I want to risk $150 per trade, divided by $28 of risk per micro E-mini contract, you can actually take the trade with 5 micro E-mini contracts. And in the worst case situation, you would not surpass $150 of risk, unless you got slippage or something like that. You will not surpass that level of risk.
Right.
That's how you calculate your size. So you would use 5 micro E-mini contracts if you were to take the trade on using the upper UFO. If you were to use the bottom UFO, the risk was a little less. It was 12 points instead of 14. So that means that 12 points times $2 per point, that is $24 of risk per micro E-mini contract. Since this trader decided he or she wanted to risk $150 per trade, and each stop out in the case of the second UFO would imply $24 per micro E-mini contract of risk, this trader can go with 6 contracts. So in other words, to adjust my risk exposure to be as constant as possible in dollars, the trade with the upper UFO would be taken with 5 micro mini contracts, where the trade using the bottom UFO would be taken with 6 micro mini contracts. And now the trader knows that you are making your outcome of trading either positive or negative. You are making it proportional in a way that is constant to your willingness for risk exposure. That's how you adjust it. It's actually very simple math. And now you get the benefit of, if you have healthy relationships between reward and risk when you trade, even if you get stopped out more often than not, you may still break even or be ahead of the game because you benefit from the healthy relationship between reward and risk, the reward to risk ratio. Whereas if you change the size and you're all over the place and you decide, I'm going to go with, 50 micros now because I feel very good today. Well, now you are totally exposed to being lucky. And if you are, yes, you can make a lot of money that day. But if you're wrong, well, now you totally killed yourself for the rest of the month, because now how many trades that are taken properly, professionally, need to be profitable just to recover for that, gamble that was executed with a random size, So that's the idea. And this is the concept that, we could add to what we have covered in prior sessions, step 1, looking at the direction, then entries and targets, and now the size.
So Jose, for new traders who might not know, and I would say if you're trading real time, it's something that you should know going into this, right? If you're not just trading on a sim account, but you're trading a real live account, you probably know this. But for those who don't, and those who might not be trading live right now, but want to practice what you just explained, is there a way to look at a chart of, let's say, the E-mini or the micro NASDAQ, right? Or you were looking at NASDAQ and you suggested the micros. So to find out how much, let's say, 1 point in the index is, or 1 tick, is there a way off the chart that you can say, okay, this represents a tick is $5. A tick is 50 cents, depending on the NASDAQ or the micro. Do you know of a way to do that? You can go to the CME's contract specs. It's out there. You can find it, because each market, like you said, is different as far as tick size, because that's the crucial part, right? Knowing what the tick size is, or knowing what the point size is, how much that is translated to a dollar amount that really affects the trader, so that you can say, oh, okay, well, my UFO, I've got the high here, the low here. That's a distance of 12 points. Now I know that risk for one contract would be $60 or $240, whatever the math comes out to be.
Yeah. So the answer to your question, this may sound a bit funny, to be honest, but first of all, is that, once you have traded these markets for a while, this is just like muscle memory, you just know it.
Right.
So to be honest, the way that would come to my mind on how to find out this information, if you are undecided or you're not sure about it because you have been trading for less amount of time and you're still kind of like, or maybe you just added a new market to your portfolio and you're not fully sure yet. So one way that, to me, is the best way to do it, even though there are other ways on how to do it, in the sense that, it's a very visual way that, for sure, what you're doing. It's to actually, with a paper money account, to take on using the Superdome with one contract only, just go ahead and take a trade, because then all those little boxes that we can see here will represent the P&L, and it will represent the amount of points that you have made as the market moved. And here, where I have the 0.0 in dollars, you will get to see the P&L of the trade. So it's very simple. You take a trade, like, for example, I go long at market, right? So I just did that. Oh, actually, I did it with 2 contracts, so that's my bad. I wanted to do it with 1 contract. I just did it with 2. I just noticed that. But anyway, so as the market is now moving, okay, you will get to see the P&L impact right here. And, just by looking at how many spaces you have moved either up or down, you will know the point value. And again, this is kind of like a very old school way on how to do it. But, it's the one way that you don't make a mistake, especially if you were to look at other products such as treasuries that have fractions, or some agricultural futures contracts that have fractions in them. It gets very confusing, and in order to avoid a mistake, what worked very well for me when I was in learning stages is just to put the trade on the DOM and see the price fluctuation right there.
So that's a great way to look at that, and just make sure you're in your simulated account when you do that, because it'll reflect what a real-time trading account would represent. It's you just don't want to place a trade if you're in your live trading account to figure it out. Yeah, no, I think that's great. And what I don't think there's enough of what you've done, Jose, here, in the sense of when we test strategies, it tends to be unit based, right? So if we were to test Jose's UFOs, just as an example, because they're up here, and you had a set of rules and you back test, generally back testing, my experience has been, I'm going to take one unit, right, and see how these trade. But really, that's not adaptive enough, right? You really want to say, I want to trade $300 worth of whatever this market is and see what my results are, is essentially what you're doing, whatever that number is that you can stomach with the risk, essentially.
Correct. So in this case, some trades would have been 5 contracts, other trades 6 contracts, or micro and mini contracts, but not one all the time. Because if you take one all the time, then basically you are ignoring cases where, because of volatility conditions, your stop should be closer or further away from entry, and therefore sometimes if you don't account for that, so you are basically sometimes being stopped out, where maybe you didn't give the market enough room to breathe, if I may use that term. Or sometimes you give it too much room to breathe, and you should have been proven wrong sooner and minimize your risk. So again, to me, the key is to adapt to market conditions. So entry and stop should be independent of your risk appetite, and I set entries and stops based on the UFOs. And then once you are given that information from the market, which may or may not be volatile that day, then you vary the size, which is the element that we control. We are the ones deciding, I'm going to go with 5, 6, 10 contracts. We have full control over that. I don't have control where to set my entry and my stop, as long as I want to adapt to what the market tells me. If I want to make it up, of course, I can change my lines. But if I want to adapt to what the market is telling me, I should be rigid with market information, and I should be flexible with the position size. So I am entering and exiting the market with realistic setups, while I am managing my risk thanks to varying the size, because, as I said, size changes risk.
Right. Oh, I love it. Jose, this is awesome. Unfortunately, ran up against time. So where can people find you to learn more about what we just talked about?
Yes, actually, I'll type it on the screen because I didn't load the website. So instead of, I will just type it. So www.tradewithufos.com. That's our website, where people can see all sorts of tools that we have over there, including educational materials, and of course, our tools for NinjaTrader that can be subscribed from there as well.
Awesome. Thanks so much, Jose. Look forward to the next time we get to speak, and hope your family and everybody's doing okay over there. And, hope good trading for you.
Thank you so much. Thanks, everyone. Always a pleasure, and happy 4th of July, everyone.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.